David Owen, let's start with you. We're all still getting all these details, but now we're looking at that long-term loan rate can be as low as depot rate plus 0.1%. What does that mean to you, the headline?
Well, the first point I'd make is the market really had got ahead of itself. I think, talk of rate cuts is entirely premature. We had some very strong, actually, domestic demand figures published by Eurostat this morning for the Eurozone first thing, and we've seen wages pick up again in Germany. They're running at their fastest rate, wage inflation there, since the commencement of the euro in '99. So I think the markets really were ahead of themselves. In terms of the TLTROs, obviously the devil will be in the detail, but obviously it's there in theory to promote bank lending. And maybe it's not quite as generous as some people in the markets were expecting, but at the end of the day, if they hit their lending targets, they can still borrow at a very, very low rate, and that will help the recovery. If it's, for the Italian banking sector, though, maybe it's not quite as generous as they were hoping, but the devil, as I say, will be in the detail. I'll have to wait, really, when I get back to the office and listen to Mario Draghi at the press conference in particular.
Which we'll be taking live here on Bloomberg Television, of course. So, David, this is really my fundamental question. When we talk about what the market was pricing in, what it was expecting, does that read through to business confidence and consumer confidence or not? Because it seems like perhaps on both sides of the Atlantic, there's a version of this going on with the Fed. The markets get really out over their skis and expecting accommodation from the central bank. If that doesn't come through, it obviously affects the markets. Does it also read through to business decisions, for example, investment decisions?
Well, I think the first point to make is that capital markets, particularly the equity market, is much less relevant for the Eurozone corporate sector overall than it is for the US or for the UK, where clearly large cap companies raise a lot of financing through markets. Most of the financing for the Eurosystem is done with the banks, and in particular, there's an awful lot of small, medium-sized companies, and the recoveries we're seeing around the Eurozone is really based around the service sector, about small, medium-sized firms. And I think in that sense, there is a clear divorce between what the markets are saying and what we can see on the ground in terms of the hard data, the Eurostat figures, the figures published by the ECB and so forth. But at the end of the day, it does matter, but it's not that relevant. I don't know anyone who uses their five-year forward expectation when negotiating pay rises. It's not relevant for most people operating in the wider real economy. It matters for markets, but it's not relevant for a lot of people on the ground.